Good morning, ladies and gentlemen. It is near the end of the year, and if we take a quick review of what has happened throughout the year, you will see that the risk on, risk off indicators, of which I can now announce you will get a completely new service next year, all automated, and you will be able to see everything that is happening each and every day completely for free. You will see that we started the year risk on, and apart from a very brief period in late August, we have been in risk on throughout the year. We have a very well pronounced downtrend. We have the moving averages all containing XLP, XLY. I'm showing you XLP, XLY, but I could show you a dozen other risk on off indicators which all point the same way. Until this picture changes, until the markets start trading above those moving averages, there is absolutely no doubt that the market will remain in a risk on period. It's just a question of, are there any 40 or 50 point retraces which are buys, or does it just keep on going straight up as it has been doing ever since really the August period. This is SPY TLT, the other main risk on risk off indicator, and as we can see again, it has basically been trucking higher all year, with just this very brief period also in August where things were indecisive and we didn't know whether we would go to risk off. Well, we haven't. We have gone to risk on full blown, and until this picture changes, until it's below the moving averages, there's absolutely no hope of any sustained downtrend in SPY. The market is just bouncing around and going higher, but the trend is definitely your friend, and the trend is higher going into 2018, certainly towards the 3000 level in SPY, SPX rather. We are certainly in an uptrend until those moving averages and these channels give way. Even one of the most volatile risk on risk off indicators, and this is the SOX, the semiconductor index, against the yen, which provides liquidity to the market, is in a very definite uptrend. Again, you can see that it tried to go to risk off in August, failed miserably, and has gone to risk on since. This picture is certainly something which unless it changes, unless these trend lines are broken, indicates far more upside next year in the early part. As you know, the seasonality is perfect. January is always a very good month. We have the Santa rally, then we have January and February, which are very good months traditionally for the market. So there is absolutely no reason to be afraid to buy any dip in the stock market until then. Do we see any trouble on the horizon eventually? Well, yes, probably. This is HYG over TLT. You can see that spreads are now lower than they were at the beginning of the year, basically meaning that people are transferring money into the safety of treasuries and out of junk paper. This eventually, if it breaks down below this level, which is 66.18, will indicate that spreads are widening. In an era of widening spreads, that is a very definite headwind for equities. The fact that they are already trading over 18 times future earnings, and the fact that the tax deal now has to be discounted at, let's call it 90%, indicates that at some stage this headwind is going to become very important for equities, and we will have the makings of a risk-off period. But for now it is just an amber indicator telling us that not everything is perfect with the world, and things can change very quickly. To us, this is at the moment the most important chart, DXY. The levels that we have penciled in here have been in there for years: 9650, 9507. We have the 200-day moving average coming to meet the market. Should we fail to break above this 9507 area and close above it and then attempt the 9650 level, we are basically setting ourselves up for a mighty fall in the dollar, and that actually will spell problems for the European markets. The European markets, you will have noticed, have been trading far more subdued over the past few weeks than the US market. The US market is being propped up by huge outflows from Europe and into the States, simply because people think that with the tax cut, corporations are going to be growing much faster in the States than they will do in Europe. We disagree with that. We don't think the tax deal is going to be a very big deal, but still we have to respect the price action of the market. To us, 9507 is crucial, followed especially by 9650. If the dollar breaks 9650, which we really can't foresee, then we are in a different world. Until then, we are just meandering and setting ourselves up for a big dollar fall sometime next year. Let us now look at the winners and losers after all is done in 2017. This is a chart of emerging markets over the SPY. You can see where we started the year 2017. We started it at this level, which is 0.15, and we're closing at 0.17, meaning that the emerging markets have actually outperformed the States by a good 10 to 15% on average. To us, that is a bullish sign for next year. Look at how much underperformance there is to make up, and we think that at some stage, with the weakening dollar, the emerging markets next year are going to spurt higher and really be the star performer. If not next year, we're certain it's going to happen at some stage. This level here is bound to be retested, and that's 0.22. So that is a good 20% higher than we are at the moment. So while there might be initial weakness at the moment in this spread, this is heading towards a historic buying opportunity for much higher levels in the years ahead. Certainly we are shifting large parts of our pension portfolio to emerging markets from the United States and from Europe, and looking forward to much better returns in emerging markets over the years to come. This is a much less volatile series, as you can see. It's emerging markets over FEU. It's not a perfect chart because emerging markets EEM is actually underweight in China and in India. So returns especially in India are not reflecting the price of EEM. But this chart, going back all the way back to 08, actually indicates to us that we have a fantastic base, and that at some stage we will be testing these highs made in 11 and probably breaking them. So certainly EEM over FEU. FEU is the stocks 50, basically dollar hedged, so this is all dollar neutral. Emerging markets against Europe, dollar neutral, so there is no foreign exchange translation. We are looking for this spread to go much higher, and therefore would avoid equities in Europe favoring equities in the emerging markets. Once again, looking into next year and trying to predict the price movements, we can see that the monthly charts are very much in a bullish mode. This to us tends to be a really important indicator, which is the monthly MACD. Whenever the monthly MACD is as positive as it is here, the momentum is with the market and really nothing is changing. Last time it turned here. As you can see, this is in late October of 2016. It gave a buy signal. Trump got elected. It just kept on trucking ever since. If you just traded the monthly MACD without even looking at anything else, you would have had a very good 2017. Now, is it overextended? Of course it is, but the monthlies, when we have such a wide gap here in the MACD, it is unlikely that the market is not going to make new highs and consolidate at those highs for at least several months, if not quarters, before there is a change of trend. As you can see, in all these periods before, there were at least 6 months of up, down, and new highs before the market said, I'm lacking oxygen up here, I'm coming back. There is at the moment no reason to suppose that the market will lack oxygen. All the economic surprises are positive. There is absolutely no reason to doubt the strength of the US and world economy. Even throughout the world, we have very growth in every sector in every country. Therefore, we can see of absolutely no reason that this market is not going to maintain this upward trajectory, always being bound by the upper Bollinger Band and not being able to make headway once above the Bollinger Band. It is very rare that the market can sustain very large moves above the Bollinger Band. It has not happened for many decades, and it won't happen now. The Bollinger Bands is going to be a limit to the price appreciation, but that is still quite higher, quite a bit higher, 2703 this month, and then it'll probably be 2725 or so in January. So certainly for the early part of next year, you can see 2750 without too much problem, say in February or March, and then it all depends on what the spreads are doing, and we will see how the market performs then. And finally, a weekly chart of the stocks. Completely different chart to the S&P chart. Wouldn't touch it with a barge pole at the moment. It seems to be quite exhausted, even though growth in Europe is very positive. It is obvious that people are pouring out of Europe and putting money to work in the States because of their perceptions of the tax bill. It is quite likely that this market could actually range trade for many weeks. Eventually we think it'll break higher, and it'll break higher with a vengeance once people realize that there is very little likelihood of the tax bill actually causing sustained higher growth in the States. And one final chart for the new year, and this is gold, which is not interesting at the moment, but is building up to be interesting maybe in the latter half of next year. It is a market which has very clear support line which says I am bullish or I am bearish at 1180 basically. what has the market done in the past few years? It has been in a very clear downtrend, which it actually started breaking this year. Now that is quite strange, because in a period of huge risk on, you'd have thought that gold would be getting pummeled and would be somewhere down here. It is obvious that gold is saying something to us, and by staying above 1180, it is actually telling us that it's building a very long-term base at these levels. Should it go down below 1180 next year, we will be wrong, and we will abandon that thesis, but we think we will see dips to 1180 to buy. Those are going to be wonderful, very low risk opportunities to get long of a market, which could be building a long-term inverse head and shoulders to go and attack the highs. Everybody at the moment is buying bitcoins and stuff like that. We think that gold is the dark horse, which at some stage next year might do great things. Well, we hope you have enjoyed watching these videos. We certainly look forward to being with you next year. We wish you a very Merry Christmas, and as I said, we have the surprise for you for next year. Sometimes in January we'll be launching the automated risk on, risk off models, so we can actually give those to you for free to thank you for being with us, and you will have a very valuable tool to guide you in your daily and weekly trading and especially investing. Thank you very much indeed, and have a very happy Christmas and New Year.